there's a type of crisis that doesn't begin with bankruptcy. It doesn't begin with a bank closure. It doesn't begin with a stock market crash. It begins with the whole world simultaneously searching for a dollar. People still believe that the USD is the safest asset globally. Whenever instability occurs, money flows into US Treasury bonds. A rising USD is seen as a sign of confidence. But what happens if the USD rises not because of confidence, but because of a shortage? If the USD becomes something to be fought over in short-term financing markets, in currency swaps, in cross-border debt, then the story is no longer simply about a strong currency. It becomes a story of liquidity. And liquidity, in the modern financial system, is oxygen. International banking systems, investment funds, multinational corporations, all operate based on the continuous flow of USD. Trillions of dollars in debt are denominated in US dollars outside the United States. Trade in goods, energy, and shipping largely settled in US dollars. Hedging contracts, derivatives, and risk insurance all require US dollars as collateral. As long as that flow is smooth, the world functions normally. But if one day, the market begins demanding more US dollars than is available in the short term, things will change. We've seen small signals before. The cost of borrowing US dollars through swap markets has skyrocketed. The spread between US dollar interest rates and the real cost of accessing US dollars has widened. Banks are shrinking their balance sheets just as funding demand surges. These movements don't appear on the front pages of newspapers. They occur in the technical markets where only a small group of experts monitor. But it is there that liquidity crises often begin. In a world where capital flows can move with a few clicks, liquidity stress can spread faster than any previous crisis. A European investment fund needs USD to meet margin requirements. An Asian bank needs USD to refinance short-term debt. An energy corporation needs USD to pay for commodity contracts. When everyone needs USD at the same time, the market no longer reacts logically, but defensively. And when defensiveness begins, assets are sold off not because of a loss of fundamental value, but because of the need for cash. In that scenario, the USD strengthens. But that strength is not a sign of stability. It could be a sign of contraction. If USD liquidity is constricted on a sufficiently large scale, the effect will not stop at emerging markets or foreign banks. It could backfire on the US financial system, tightening credit conditions, pushing yields higher, reducing investment and employment. The issue isn't whether the USD remains the global reserve currency. The real concern lies in the moment when the world simultaneously needs more USD than the system can supply in the short term. And if that moment arrives, the shock won't stay at any border. It will spread back to the center, where the US economy seems to be stable. Looking at international financial headlines, the message seems clear: the USD remains central to the system. Whenever instability arises anywhere, from geopolitics, regional recession, to market volatility, money flows back to the US. Treasury bonds are still being bought. The USD continues to appreciate during periods of tension. Global institutions still hold USD reserves. From the outside, this structure appears as solid as an anchor in a turbulent ocean. And for decades, that was true. The United States possesses the world's deepest, most liquid, and most transparent financial markets. No other currency can replace the USD in oil trade, supply chain financing, or large-scale foreign exchange reserves. Even as many countries talk about de-dollarization, the vast majority of cross-border transactions still pass through the USD system. In the version being told, a strong USD is a sign of systemic health. When the global economy falters, the US becomes a safe haven. When risk increases, the demand for USD increases. This creates a seemingly perfect loop. The world needs USD rightward arrow, USD strengthens rightward arrow, confidence strengthens rightward arrow, the system continues to function. But there is a crucial detail often overlooked in this narrative. The USD doesn't just exist as static reserves in the central bank's vault. The vast majority of global USD essentially exists as credit, created through lending, through bank balance sheets, through the repo market, and through currency swap agreements. In other words, the global USD is a dynamic network. And this dynamic network depends on the smooth flow of funds. As long as banks are willing to lend each other short-term USD, as long as the currency swap market operates with stable spreads, as long as dealers have sufficient balance sheet space to mediate liquidity, the system continues to breathe. On the exchange rate chart, we only see whether the USD is strong or weak. But behind that lies another question: is the USD circulating easily, or is it becoming more expensive to access? A currency can be strong because of confidence. But it can also be strong because everyone is trying to accumulate it. These two phenomena look similar on the surface of the data. But in the financial structure, they are opposite. If the USD appreciates because investors voluntarily seek a safe haven, that's asset displacement. If the USD appreciates because institutions have to sell assets to repay USD debt, that's liquidity displacement. In the latter case, the market doesn't operate on confidence, but on defense. The common narrative rarely distinguishes between these two states. It looks at composite indices, foreign exchange reserves, and yields. But past liquidity crises often didn't originate from growth data. They started in the financing market, where short-term borrowing costs changed before the real economy could react. A bank might still report sufficient capital. An investment fund might still have positive net assets. A multinational corporation might still be profitable. But if they can't access USD when they need to make payments, the system starts to contract. And this contraction doesn't happen noisily. It begins with narrowing limits. Transactions are delayed. Contracts are renegotiated at higher costs. From the outside, the market remains stable. But internally, flows are beginning to slow. In a system where trillions of dollars in cross-border debt need constant refinancing, a few percent slowdown in flows at just the right time can have far-reaching effects. The US dollar may continue to be strong on the chart. Bonds may still find buyers. But the difference lies in the dynamics of the money flow. And it is this difference that determines whether the system is operating on trust, or shifting to survival mode. Leaving aside the exchange rate charts and reassuring statements, the picture changes drastically when looking at where USD is actually borrowed and repaid each day. The vast majority of USD outside the United States doesn't sit idle in vaults. It exists in the form of short-term loans, currency swaps, trade finance, repos, and derivatives. European banks borrow USD to lend to businesses. Asian investment funds use USD for hedging. Energy companies in Latin America issue USD-denominated bonds to benefit from lower interest rates than their local currencies. This system operates on an implicit assumption: USD is always accessible at a reasonable cost. But that assumption is only true when trust and liquidity coexist. When instability increases, regional recession, interest rate volatility, geopolitical conflict, the need for hedging increases. Financial institutions want to hold more cash. Funds want to reduce leverage. Businesses want to ensure they have enough USD to pay their obligations. And that's when the demand for USD surges the most. It's noteworthy that much of this demand doesn't come from the US economy, but from the rest of the world. A European bank might have assets in euros, but if its debt is denominated in USD, it needs USD to make payments. An Asian export company might sell goods in USD, but if cash flow is slow, it needs to borrow USD short-term to stay afloat. Under normal circumstances, the currency swap market allows them to convert their local currency to USD at a small cost. But when tensions arise, this cost can rise rapidly. That's where the clash occurs. The demand for USD increases simultaneously in many regions. Meanwhile, US banks, the primary source of liquidity, are facing balance sheet limits, capital requirements, and stricter regulations. Following recent banking turmoil, many financial institutions have become more cautious about short-term risk. They are holding onto their own liquidity instead of expanding interbank lending. This caution is reasonable at the individual institution level. But at the systemic level, it constricts the flow. A modern financial market doesn't need an absolute shortage of USD to experience a crisis. It just needs a shortage of USD at the right time. When an investment fund cannot borrow USD at an acceptable cost, it is forced to sell assets. When many funds do the same, asset prices fall. Falling prices trigger additional margin requirements. Demand for USD increases further. The vicious cycle begins to amplify itself. What makes this scenario dangerous is not the total debt figure, but the short-term refinancing structure. Trillions of dollars in obligations must be constantly rotated. If one link is blocked for a few days, the pressure can spread. History has shown such moments. When interbank markets freeze, when currency swap costs skyrocket, when central banks have to intervene to inject emergency liquidity. The difference with the current system is speed. Electronic trading, instant capital flows, automated trading algorithms, all make market responses much faster than 2 decades ago. What used to take weeks can happen in hours. If many institutions simultaneously shift to a defensive stance, the USD will become the most tightly held asset. And in that state, the USD will strengthen even further. But that strength doesn't reflect stability. It reflects contraction. When global liquidity is squeezed, economies dependent on the USD will be the first to feel the pressure. Domestic currencies weaken, borrowing costs rise, and asset markets become volatile. However, The U.S. financial system is not immune to this turmoil. U.S. banks have cross-border lending relationships. U.S. investment funds hold global assets. U.S. businesses depend on international revenue. When global liquidity contracts, cash flow and profits can be affected. And when external pressure is strong enough, it can backfire on domestic markets, through tighter credit conditions, through higher costs of capital, through widespread defensive sentiment. Global demand for USD and real liquidity constraints don't always conflict. But if they collide during a prolonged period of high interest rates and large cross-border debt, the system can enter a chain reaction that is difficult to control. The question is no longer whether the USD is strong or not. The question is whether the global financial system is flexible enough to supply USD when everyone needs it. To understand why a USD liquidity shock can go beyond the technical realm and become a real economic crisis, one needs to look at the structure of the modern financial system. This system doesn't operate as a single unified entity. It's a network of interconnected commercial banks, investment banks, hedge funds, pension funds, insurance companies, and a host of non-bank financial institutions. Under normal circumstances, this network distributes risk and liquidity efficiently. But under stress, that very interconnectedness amplifies the shock. The first link lies in the bank's balance sheets. After years of tightening capital and liquidity regulations, large banks hold significant amounts of high-quality assets. However, these safety requirements also make them more cautious about expanding their balance sheets when the market is volatile. When demand for USD surges, banks may choose to hold liquidity rather than provide more to the interbank or swap markets. At the institutional level, this is a reasonable defensive behavior. But when many institutions defend themselves together, system-wide liquidity contracts. The second link lies in the non-bank financial sector, investment funds, money market funds, hedge funds, and highly leveraged institutions. These institutions do not have direct access to the central bank's discount window. They rely on short-term financing markets. When the cost of borrowing USD increases or credit limits are narrowed, they are forced to reduce leverage. Reducing leverage means selling assets. If only one fund sells, the market absorbs it. But if many funds sell together to accumulate USD, the asset price falls faster than it reflects its fundamental value. The price drop triggers additional margin requirements. Margin requirements increase the demand for USD. In turn, increased demand for USD leads to higher financing costs. A self-amplifying spiral is formed. The third link lies in the U.S. government bond market, the foundation of global pricing. Under stressful conditions, Treasury bonds are often seen as a safe haven asset. But if institutions have to sell bonds to raise cash, yields could rise instead of falling. Rising yields mean higher costs of capital. Rising costs of capital mean tighter financial conditions. This doesn't just affect global investors. It directly impacts U.S. businesses, from large corporations to small businesses, through higher borrowing costs. The next link is the derivatives market. Interest rate, exchange rate, and commodity hedging contracts all require margin. When volatility increases, margin requirements increase. These requirements are typically settled in USD. The higher the volatility, the greater the demand for USD. The greater the demand, the tighter the liquidity crunch. The system begins to shift from optimizing profits to preserving liquidity. And as defensive sentiment spreads, long-term investment decisions are delayed. Businesses reduce bond issuance. Banks tighten credit standards. Investment funds hold cash instead of allocating capital. Growth began to slow, not because consumer demand collapsed immediately, but because financial conditions quietly tightened. The danger of this mechanism lies in the time lag. Real economic data often lags behind financial markets. When unemployment rises or production falls, the liquidity spiral may have already begun months earlier. And once confidence is shaken, restoring normalcy is not simple. Central banks can provide liquidity through emergency tools, but intervention usually occurs after stress has become apparent. In a scenario of global USD liquidity crunch, these automatic mechanisms can be triggered almost simultaneously. It doesn't require a major bank to fail. It doesn't require a country to default. As long as the market believes liquidity is becoming scarce, defensive behavior will create scarcity itself. And when that scarcity spills over into domestic credit conditions in the US, the real economy begins to feel the pressure. In the early stages, a USD liquidity crisis is often seen as a problem for the rest of the world. Domestic currencies in emerging economies weaken. Their bond yields rise sharply. Stock markets become volatile. But in the tightly integrated global financial system, such shocks don't stop at borders. U.S. banks have cross-border lending. U.S. investment funds hold global bonds and stocks. U.S. corporations depend on revenue from foreign markets. When external USD liquidity shrinks, these links begin to feel pressure. First, there's the asset market. If global institutions are forced to sell U.S. assets to raise USD, U.S. stock and bond prices could face unintended selling pressure. Volatility increases. Long-term yields inch higher. Financial conditions tighten. Next, there's corporate credit. As yields rise and risk appetite decreases, issuing bonds becomes more expensive. Companies with low credit ratings have to pay higher interest rates to refinance. Businesses that rely on short-term capital markets may struggle to roll over debt. In that environment, investment is delayed. Expansion plans are postponed. Hiring slows down. The initial liquidity shock, stemming from global USD demand, began impacting domestic economic decisions in the United States. Workers may not see the currency swap market. They don't monitor interbank funding spreads. But they feel it when businesses cut hours, when projects are canceled, when consumer credit becomes more difficult to access. Domestic banks, facing market volatility and increased risk, tend to tighten lending standards. Home loans, auto loans, and small business credit may be subject to stricter scrutiny. The spillover effect from financial markets to the real economy doesn't need to be dramatic to be dangerous. It can occur subtly, through higher capital costs and widespread caution. At the same time, a stronger USD due to liquidity stress could weaken the competitiveness of U.S. exports. Revenue from international markets converted to USD may decrease. Profit pressure increases. The feedback loop begins to form. Global liquidity tightens, rightward arrow, assets are sold, rightward arrow, US yields rise, rightward arrow, credit tightens, rightward arrow, growth slows, rightward arrow, defensive sentiment spreads, rightward arrow, demand for holding USD increases. A capital system operating on leverage and continuous refinancing becomes sensitive to any disruption in the flow of money. It is noteworthy that in this scenario, a clear collapse event is not needed to create a far-reaching economic impact. A gradual contraction of financial conditions may be enough to push the economy into a recession. And when the recession begins, confidence, the most important element of the financial system, becomes fragile. Investors become more cautious. Consumers become more reserved. Businesses become more defensive. The liquidity shock is no longer just a story of the money markets. It became a story of work, income, and spending. Then, the impact comes back to what is considered the center of stability of the system, the U.S. economy. A financial system can withstand interest rate fluctuations. It can withstand temporary losses. It can even weather market shocks. But it cannot function if confidence in access to liquidity is shaken. In a global USD liquidity crunch scenario, the most dangerous thing is not an absolute lack of money. The danger lies in the moment when institutions begin to believe that liquidity may no longer be available when they need it most. That confidence is the foundation of credit. When banks believe they can borrow USD at any time, they are willing to lend. When investment funds believe the repo market will always be open, they are willing to maintain leverage. When businesses believe they can refinance on time, they dare to expand. But when confidence shifts to defensiveness, behavior changes immediately. Liquidity is being withheld instead of distributed. Cash is being hoarded instead of invested. Risk is being narrowed instead of accepted. This shift doesn't require an official announcement. It happens quietly in trading rooms, in risk management meetings, in the daily decisions of financial institutions. And as defensive behavior spreads, it reinforces itself. Asset markets become more volatile. Funding costs are higher. Credit flows slow down. The U.S. economy, despite being the central issuer of USD, still depends on the global circulation of this currency. When that circulation shrinks, the pressure doesn't stay outside its borders. If the USD strengthens sharply due to liquidity shortages, exports come under pressure. If yields rise due to sell-offs to accumulate cash, domestic borrowing costs increase. If global capital markets are strained, U.S. businesses find it difficult to raise long-term capital. From there, growth slows down. The labor market reacts with a time lag. Consumer sentiment becomes cautious. An economy may not collapse in a single day. But a prolonged contraction of liquidity and confidence can create a series of declines deep enough to shake the financial structure. In this scenario, the central bank could reopen liquidity swap channels, inject USD into the system, and stabilize funding markets. History shows that these tools can quell short-term panic. But each time the emergency mechanism is triggered, the system sends a signal, it is operating near its limit. And when the limit is tested too often, the story is no longer just about liquidity techniques. It becomes a story about the global debt structure, about dependence on the USD, about the level of leverage of the modern financial system. The USD can still play a central role. the market can still stabilize again. But if the world continues to expand its obligations in USD while liquidity becomes increasingly sensitive to volatility, each future shock will be bigger than the last. The remaining factor is not today's exchange rate. It lies in the system's ability to provide liquidity when everyone needs it. And if one day that demand exceeds the supply at the right time, the impact will not be just a market fluctuation. It could be the moment that forces the world's largest economy to confront the limits of its own currency.